it was coming up with solutions and finding the right person. You might not be able to put in an offer and get it at the price you want. You might have to try a few times to find that pain point, and that pain point might not be there. Don't worry about it. Since this recession is a lot lighter, or this future projected recession, says Fannie Mae, projected 2023 recession, that it's going to be lighter landing because of all these forbearances and assistance that these banks have provided, where you could defer loans, and it's also a lot more qualified people that have loans, whereas last recession, a lot of people that were unqualified had the loans.
I agree. I think getting creative is going to be the name of the game, be it in financing, be it in finding deals. I'm not just going to be able to pop on the MLS and say, look at these options.
Yeah.
So I got a lot to learn.
Thanks, man. Appreciate it.
Hey everyone, I can go next. Brian Foster here. Recognize the number of faces. Nick, Jeff, Joe. Nice to see you guys again. Carlos isn't on, but he was my realtor I worked for. I'm actually sitting here close to where we'll be having our networking event next month in the triplex that I bought, again, with Carlos in Columbia Heights. So that's quite a story, longer story for another time. But Jeremy actually was talking with Greg for a bit. It didn't end up working out on this particular deal. I was able to secure a better rate, so of course went with that. But looking forward to hearing what you have to say, and always interested. You come highly recommended from Nick and Carlos, so happy to have another conversation in the future. Quick plug for what I'm looking for next. I'm in full renovation mode, looking to launch my Airbnb this weekend. Just secured a long-term lease with some law school students for the upstairs unit here. And then I'll be moving into the first unit, but looking to finance a very large, I think it'll cost between 125 and 160,000 full basement renovation into a 3-bedroom, 2-bath. But you can imagine with the high price tag on a property, the debt to income starts to get a little interesting when I look at some of the financing vehicles. So Jeremy, I think I have a ton of equity in this property already, but I'm curious to see if you have any products, or maybe we can have a conversation offline regarding getting financing based off of equity. Great W2 income and all that, but again, we can talk offline about it. So good to be here with everyone.
It's always a balancing act between equity and getting the next one. Go ahead, Scott.
Yeah, it's my second meeting. Thank you for having me. Joe, I'll have to talk to you. I purchased 2 properties, condominiums in DC, and fill them with Section H voucher holders. I'm looking to do similar things, but bringing on equity partners now. Actually, I've moved along since the last meeting and met with an attorney who's a really good deal maker. So we're putting together some corporate legal structures, and I'm going out and tapping my personal network. I've also gotten some introductions to some alternatives to Section 8, but are also HUD financed type deals, and I'll be interested to see how those cash flow. I'm also curious about how Section 8 works outside of just condominiums. So it'll be interesting to talk to you about that as well. Thank you.
Thanks, Scott.
Is it my turn?
Yes, Sonia.
Okay. I'm Sonia, and I'm here to listen to what all of you have to say. I've known Carlos for a long time, and I became good friend with Nick. I am here because Carlos and I have been desperate to try to find something for my son. He has a very good job, but we're just trying to get him to buy something, and he's, what can I say? He's like these young people. He's always scared to buy something, and he should. So I'm just here to listen to what all of you have to say, and just to get back to him.
Well, thank you, Sonia. And you've ridden some recessions in your days, and you were selling real estate. I'm sure could have some insight. When was the last? Was there an interest rate spike in the 80s, late 80s, when you were selling real estate? I guess it was a little different the
Listen,
prices will
I will
probably,
do that in 86. I will be doing that for the year. So I've seen all interest rate. I've worked with all kind of interest rate, and you just have to be able to. But you know, lots of my people were all cash. It was I was working on different things, but I have helped a lot of young people, and they are still in touch with me. And you just have to find a way to help them. And some of my young people have made so much money with those helping them. You just have to find a good way to help young people and to make sure that they are not going. What I was always doing was making sure that they are not going to overbuy for their limit, for their budget. That I was always trying to do that. I will never, there was sometimes, there was some agent, let's say if they could, let's make an example, because back then it was, you know, different. If they could offer for 200,000, some agent will push them to buy 250,000. I will never do that, because then they will end up in so much trouble later on. I will always sure that they will buy.
even though, sorry to interrupt, even though it was higher interest rates, we're talking about 8, 9, 10 to 18%. The price points were a little bit different.
Yes,
200,
but
300.
I have not really worked when it was that high interest rate, and I don't think we are going back to that high interest rate. Right now we are about 4%. And yes, and what I think we can do is, well, it depends if you want to buy an investment or if you want to buy for yourself. I think if you want to buy for yourself, you can take a 5-year arm, because after 5 years, probably you won't be in the same place if you're going to buy for yourself. Or you can also refinance. I don't think in 5 years it's going to be much higher. I think it's probably a very good way to talk to younger people, to do a 5-year arm, rather than to do a fix right now. But that's...
Thank you, Sonia, and that leads us into our itinerary. And I'm sorry to cut you off, but want to make sure.
Go ahead. I mean, I don't want to take up your time. That's
No
just my opinion.
Thank you, Sonia. So that leads us into our conversation. Jeremy's going to give us a little update on different programs and where he's seeing rates right now. Then we're going to go through 2 different impacts, the negative impact on real estate investing and positive effects or events that are affecting real estate investing. Increase in rents. So there's a lot of news that rents are still growing, and it's up to 30% in some areas. In DC, it's up to 20%. But naturally it is very high. And then looking forward, you know, what to expect going forward in real estate investing, and specifically with rates. And then just a little market update. June report came out, and we're actually seeing a slowdown, 70 to 80% of what we've seen in 2020 and 2021. So, you know, maybe some people say, well, that wasn't the norm, right? That was a little bit excited. So maybe we're going back to normal or 2019 capacity. So we'll see. Without further ado, with rates and everything else mortgage related, Jeremy Kingsbury.
Thank you, Nick. Yeah, I don't think it shouldn't be a mystery to anybody on this call that rates are up significantly across the board this year. And really, the whole thing behind it, yeah, there's a lot of things that go into it. You know, you can throw in the war with Ukraine and oil prices. All of it, the majority of what it boils down to is where inflation is right now. That's the main driving force behind why rates are up so much. And just to give a little bit of background on that, you know, from the investments standpoint, people that are buying 30-year mortgage-backed securities, they're getting a set return on this bond that they're buying. Now, as the value of the dollar decreases because inflation goes up, that set return that they're getting on that bond that they're buying is worth less and less. So as inflation goes up, the return that they're getting, which is already, set, is not going to be worth as much. So to entice people to keep people buying mortgage-backed securities, the way for the supply and demand model to work, rates have to go up to entice people to keep buying these bonds. So right now, as Nick pointed out, inflation is at a 40-year high. And it's, and that's when you hear the Fed talk of, the Fed are raising rates. They're raising their rates. And unfortunately, the general public thinks that when the Fed raises their rates, that automatically means that mortgage rates are going up, which in actuality, a lot of times the inverse happens. So the Fed is raising their rates. The reason being is because they see the inflation numbers. They know they're way behind in the action that they should have already been taken before now. So they're raising rates at a pretty quick pace to try to get inflation back under control. But it's going to take time. And realistically, the experts that we listen to that are the best in predicting where things are, everyone's saying, look, rates will start coming back down, but it's probably going to be the end of this year, potentially into the first quarter of 23 before we see real substantial movement back down in rates. So what we've seen on internally, our volume has slowed substantially. I'd say as slow as we've seen in over 10 years. Granted, it was, the real estate market was at such a crazy pace for the last 2 years that, that wasn't sustainable. But through May, June, I'd say the first half of this year was what we would consider normal volume for, a year that wasn't COVID related. We didn't have rates in the 2% and things like that. So, first half of the year, our volume was on par with what we consider a normal year. And then the last, really just been kind of like the last 6 to 8 weeks, most of the people that I've been talking with are saying, look, I'm just starting the conversation, but I don't want to purchase anything right now. I'm waiting until the fall or end of the year. I'm just kind of letting the summer play out and then pick back up in September, October.
Yeah, I think a lot of people are definitely interested. Real estate is the top of the conversation besides the war and the stock market and some other current events, Roe versus Wade. This is, one of the things. Real estate is at the top of the mind of a lot of people. And telework is definitely playing a factor. And whether that's going to be drawn out after these mass restrictions are lightened up and the vaccination rates increase. Question for you, Jeremy, is the people that you are talking to that are just starting jobs, are you seeing more applications from people moving into DC as companies open up jobs, or is it about the same or a little bit less?
So, I mean, it's DC. DC is such a transient city that's pretty much the norm all the time. Especially, we do quite a bit of VA volume here just because the nature of, having the Pentagon here and Andrews and Bowling, there's a lot of VA clients in the area. But just DC in general, especially during an election year, there's always additional turnover from that. So, yeah, I mean, that's kind of been the norm, in any market really. So, one thing just to point out, just to add in there.
And after you say this point, sorry to interrupt.
What's that? I'm sorry.
Someone had a question.
Okay.
After you're done.
I just wanted to add in one point that we were talking about internally recently. It's something that they're not talking about on a broader scale is the fact that, the majority of people's student loans have been in forbearance, deferment for a couple of years. And next month, if they don't kick the can down the road again, that's going to expire and people are going to have to start paying on their student loans again. So, that is also, it's hard to put into numbers what that has done to inflation, because people have more disposable income that don't have to pay their student loans. So that not only could that help slow inflation a little bit, but it's also going to impact where a lot of people are on a comfort level as far as, what they can afford with their housing payment.
Yeah, I think that
Nicholas,
go ahead, Jeff.
yeah, I had a quick question, but actually two questions. One, so the rates are as we see it now. Are they at 5.25? Like if someone has a good, over a 650 credit score, what are we, and is it going to go up? Because I have an opportunity to buy 2 more houses this week, one in Pasadena, Maryland, and one in Laurel. I had one that just went live in Marshall, Virginia, and I'm just worried that the rates are going to keep going up and that might affect my pool of buyers. I just want to see. And then secondly, I have an opportunity to buy a house right outside DC. It has Tesla solar panels on it. Can you just speak to about how houses that we rehab that have solar panels on them, this one has a 12-year lease left on it, how that would affect you financing someone?
So as far as the rates go, that's a very loaded question to kind of answer, because it depends on if it's somebody's primary residence versus an investment.
Yeah, primary residence.
You,
Single-family homes.
you mean 5.25 for primary residence? You can find much better than that.
Yeah, in a lot of situations, a lot of people, the rate is higher than 5.25%.
Definitely.
Pardon me? What did
But
you
30-year fix, Sonia. Remember, 30-year fix. We're talking about the standard, conventional, not non-conforming. Which,
Okay.
yeah, your price points are jumbo territory in terms of whatever it is above 700. I don't know, Jeremy, the breaking point where you could do arms and it would become more advantageous.
Okay.
Yeah, I mean, realistically, something, we don't see all the time. Our jumbo pricing right now is better than conventional loan rates. So, that's it. The conventional rates have gone up significantly quicker than our jumbo investors have this year. So it's different for everybody. I personally don't think we're going to go up too much higher. I think we in a lot of scenarios kind of peaked around 6%, and we've just been kind of bouncing up and down since then. I'm thinking, certainly Q4 this year, we should start seeing things tick back down. But that being said, nobody saw them rising as quick as they did this year. Nobody predicted that. So it's.
And Jeremy, what about solar panels? Like this house that I'm trying to flip in Rockville has a 12-year solar panel lease with Tesla. And the agent's like, oh, it's not a big deal, but I was doing some research on it. And it says that it would affect, like, if a person has a mortgage, plus you take into effect what the solar panel monthly rates are. And the solar panel people have to approve the new buyer that you're flipping it to. Can you just talk to us about that a little bit?
Yep, no, certainly. And that's something, the biggest question mark with that could be who the leasing company is. Some of them respond really quick, and essentially you have to get the lease transferred to the new owner. And if the leasing company is reputable and they're responsive, then it's not a big deal. You get that, it is another, if there's a lease on it, there is another liability that we have to attribute to the buyer. So if it's, $150 a month on the lease, that means they have to be able to, absorb that additional monthly payment. But it's the only times we've had issues, it have been where the leasing company is just not responsive and has taken a long time to get us the documentation we need and get that lease properly transferred over to the new owner's name.
Yeah, I guess it depends. I mean, for mine, it was luckily owned outright, so that was an asset. But it sounds like if it's a monthly payment that's guaranteed to happen, right? You're looking at future cash flow in terms of debt and income. This would be a debt, unless you sell them, which would be a whole nother thing. And because I think it's a little bit tricky there. You don't need them unless it's somewhere in the clause where you need to keep them X amount of years.
Yeah, but if they're not owned outright, if there's a lease on it, we have to get it transferred to the new buyer's name. Otherwise, you can't have these panels in somebody else's name if you're buying the house. So whenever we've had any troubles with it at all, it's always come down to the leasing company and getting them to get us the paperwork we need to transfer it over.
Hey, Jeremy, I've got 2 quick questions for you.
Mm-hmm.
And thanks for taking time out of your night to meet with us. I really appreciate it.
Not a problem.
So you said earlier that when the Fed meets and actually does hike rates, that the actual mortgage rates tend to come down.
Mm-hmm.
I know it kind of sounds similar to the stock market where you just can't predict what's going to happen day to day. Why is that on the announcement that you would see it trend down?
So you're talking about 2 very different rates. The Fed overnight rate, you're talking about a rate to borrow money essentially overnight versus a 30-year mortgage rate. So investors, when the effect of the interest rate hike by the Fed is that inflation's going to start coming back down. So when the large investors out there, they see the Fed finally taking action, they know what the long-term result's going to be. So when they see the Fed raise rates, they're like, okay, good. They're taking control. They're going to get this inflation back down. I feel more comfortable investing in bonds at this point, knowing that inflation is going to come back down. And my return on this bond is going to be worth more when inflation comes back down. So that's why we see kind of the inverse result there is, what the outcome of the higher Fed rate is going to cause is what helps mortgage rates.
Okay, I can see that line of reasoning. My other question really has to do, obviously you don't have a crystal ball, with why you think rates are going to come down by the end of the year. If we're at historic highs, we still haven't managed to curb it. And let's say next month, great, we do manage to level it off. It's not leveled off at 3%. Right. It's got ways to come down. And let's say, looking historically, that 1% rate, sorry, 1 second, that 1% rate of change that we had last month was the fastest rate of change ever, right? So that's an outlier. It's going to take at least 8 or 9 months at that same rate of change to bring the rate down to gravity or to normal. So I just don't see that happening before the end of the year. Where do you see rates coming down in the next 6 months, or I guess why, and is it meaningfully?
And just, looking at it kind of like a pendulum. Rates were so low for 2 years. They were lower than they've ever been. And now, in 6 months' time, swing back up, kind of a knee-jerk reaction, to go from 2.5% up to 6%. A lot of it was, there's a lot of talk that the inflation was transitory, and it's transitory. It's not real. These numbers are, it's just supply chain thing. They'll get it figured out. When everybody finally admitted, okay, no, this inflation's a real thing, mortgage rates shot up faster than they ever have in history. So they've shot up, in a lot of cases to 6%, or some scenarios higher than 6%, and they've kind of leveled off for a little bit. So that's my line of thinking, that look, they're taking action. It does take time for the Fed action to actually cool inflation. Now, obviously, am I guaranteeing rates are going to come down by the end of this year? Certainly not. Just my gut feeling that the rates went higher than they should have, like an overreaction by the market. And it's going to reach a point where, like, okay, everybody settle down. And it's, I'm not saying we're going to be back at 3%, but I'm thinking that we're going to start seeing the trend line coming back down.
Thank you. And I guess one quick follow-up question.
Yeah.
Are you also a real estate investor outside of your lending practices?
As Nick mentioned, I have 3 daughters, so I do have a second home of my own. But yeah, a lot of my personal income goes towards college savings and everything else at this point. So I had one other house that I ended up selling. The right situation came along that it made sense to sell last year, and got a lot more for it than I ever thought I would. So obviously, I'm a believer. I'm very much a believer in the market.
I was going to say, where are you advising your clients to go in terms of ARMs? Right now I've got 3 fixed-year, 30-year fixed-rate products. I'm open to a 10-year. It doesn't scare me whatsoever. A 5-year, I get shaky. 7 to me seems a decent sweet spot, but I haven't lived long enough to know any of this,
Right. And again, based on the experts that we listen to, that, across the board, some think Q4 this year, some think Q4 23, rates will be coming back down. The consensus, regardless, is within the next 2 years. Anybody who's buying right now is probably going to be turning around and refinancing, within the next 18 to 36 months. So everybody's situation is different, from risk tolerance to what they're buying for. So, if I have a first-time home buyer who's buying a condo, I know historically that first-time home buyers with a condo don't stay in that property on average more than 3 years, give or take. So
that's what I was saying. So it doesn't make any sense for them to get a 30-year loan.
Right. Yeah. I mean, for that person, yeah. I mean, or, in particular for somebody who's, they're moved to DC for a job assignment. They know they're going to be here for 4 years. And then they're moving to their next assignment. Not a whole lot of risk to a 7-year ARM when they know they're only going to own the property for 4 years. Again, that would certainly be my advice. Some people, regardless, it doesn't matter. They could know that they're selling the house in 3 years and still will not entertain an ARM. So it's, any given person's risk tolerance is certainly going to come into play there.
Got it. Thank you very much. I don't want to take more time by asking about various lending products that you offer. I can always reach to you offline.
Certainly.
So thank you for your help.
Yeah, no problem.
I think Joe had a question.
Yes, I have a question for Jeremy. So in terms of like tapping into the equity of a primary residence and like rising interest rates, is the best way to get a HELOC versus like cash out refi? Or have you seen anything changes like volume or like terms for HELOCs and cash out refi?
So yeah, the volume for HELOCs in the last couple of years has gone through the roof for sure. As people have a lot more equity in the house than they realized. I certainly, right now, a cash out refinance right now is something that we're not doing any of. Reason being, most anybody who's would even be entertaining that means that they bought last year, 2 years ago, 3 years ago, and they're going to be, interest rate in the 2s and 3s. And it doesn't make sense to do a cash out refinance at 6%. Where, yeah, let's say you take a HELOC, let's say you get a HELOC at 7 or 8% even, 7 or 8% on a much smaller loan is significantly better than doing a cash out refinance at 6%. So, and again, like the last topic, it all depends on the individual person as well, what they're looking to do. There are places out there that offer, a fixed rate HELOC, so you don't have to worry about the rate changing every time the Fed raises their rates. So there's a bunch of different options to look at with that, and depends on what your plan is for that money, how long you plan, before you intend to pay it back, as to what is going to be the best option for you.
Yeah, I think cash out refis are no longer a thing.
Yeah,
they're halted.
The only ones that we've done this year have been divorce buyout situations where they have to refinance to get one person off of the loan, and access the equity at the same time. Those are the only ones we've done this year.
I'm going to go ahead and continue. Jeremy's information is on here. Jeremy, I don't know if you're available to stick on for the next, 15, 20 minutes.
Sure.
But I was just going to dig a little bit deeper in everything we're talking about, and just really point it into reference. When you're looking at an economy, you're looking at two factors, micro and macro. Macro is really the things that are changing real estate. Micro things like, the job market in DC, that's very strong. The housing market is always going to be strong. And that's in my really moving forward point is we're in a microeconomic environment that luckily the job market is very secure. So we're going to be seeing real estate prices go up, whether that's going to be large jumps, probably not, but definitely incrementally like it's been doing for decades. But macroeconomics, it affects everyone. Inflation, so the cost of money and how much you could buy with $1 is decreasing. You could buy less gas with $1. Gas has just gone up so much. Food, poultry has gone up a lot. Those commodities are definitely increasing, and that's causing a negative impact on real estate. So if the dollar keeps on going down in terms of value, or inflation goes up, it's going to negatively impact your house, because you're going to need, even though you're getting more money, when you sell it, that money is not going to be able to purchase as much as what it could have been purchasing a day ago or a year ago. Dollar cost averaging, I think, is the technical term. And the second thing is monetary policy. What is the government doing? The Fed, when they could do two things: increase interest rates or change taxes. Interest rates is really what is being affected, and I want to say the Fed funds rate, if I think is the technical monetary policy, and that affects how much banks can lend to one another. And it's a trickle-down effect, so it doesn't automatically impact you in terms of interest rate, mortgage interest rate, because the mortgage interest rate's tied to the bond market, but it does impact you in terms of how much it costs in terms of money, and how much money costs. Stock market always has a negative impact because of the consumer confidence part and the wars have a negative impact. And actually, these last two, I don't know, you could kind of debate whether they have a negative or positive impact on real estate now that I'm thinking about it. And they're probably secondary influences. They don't directly correlate. So I'm just thinking usually real estate does well around wars. Thanks for sharing that, Rich. Jeremy, would you say that wars, I mean, I think that would be up for debate, whether they have a positive or negative impact on real estate values.
Yeah. I mean, like you
Like
said,
Carlos
consumer confidence. I mean, I will say during recession times, housing has always done well. Reason being is that, you know, during a recessionary time, people they put less money in depreciating assets. You know, people don't buy boats. They spend less towards, you know, buying cars and things that aren't necessary, and put more money towards things that are appreciating assets like homes. So, you know, like the last, you know, if you look, you know, recessions going all the way back to the 70s, every recessionary period, housing prices have been on the rise during every single one of them.
Yeah, and I'm trying to pull it up here, but the Fed or the St. Louis Fed releases a chart, and I think I have that snapshot, is that it, you know, real estate during recessions do better because they are more sound investments. So whether that's a negative or positive, I might put that in a neutral position. So just a clip from the Washington Post I wanted to share, and I sent around the article. June inflation soared to 9%. So you could see other times when that happened. The gray is recession. So if you're looking at 2010, 2000, 2001, and the late end of 1980, you could see that's when there were recessions in this gray portion here. And we're at 9%. So the last time that was that high was back in the mid 80s during the S&L crisis, or the savings and loans crisis. So surprisingly, the Fed, increased the rates of the Fed funds rates. It dropped significantly. So I think Jeffrey was saying it was such a quick time, but it lasted for a lot longer. So the pendulum usually swings back and forth, right? But it kind of stopped at 3%. People are like, what the heck? What the heck is going on? You know, the Fed basically said, hey, we're not going to charge anything for interbank transfers. So banks could lend money to each other, do overnight repos, which help kind of the liquidity. Liquidity is the main function of getting the economy going. So they said, hey, look, we're going to drop the Fed funds rate to increase liquidity, to increase the plumbing, so it goes quicker, so it unclogs the financial system. And now they're clogging it back up. They're saying, whoa, we kind of really juiced it, and we did it for too long. So not that they're increasing it more than what it was, but it is back to the bounds of where it was back in 2019, 2020. I put positive things, and again, these could kind of be speculative, whether they're negative, positive on real estate. But I think a positive thing is unemployment rate. Geez, you know, we got to look at that stat. That's really holding up the real estate market here in DC. People have jobs, people make money, people need places to live, so they're going to either rent or buy. The rent prices have skyrocketed 12%, over 12% in some areas in DC. And real estate prices have gone up certainly more than 10% in some areas. that's because people have jobs, people have money to spend, people have money to spend. Disposable income and savings are at an all-time high. The GDP, looking at where money is, savings is definitely a bigger portion now that we're in a recession. People, or not in a recession, in COVID, people have saved more, and consumer confidence is still up. I mean, I looked at some article yesterday about Amazon. Amazon broke their Amazon Prime Day by a ton. So people are still buying, even though money is not going as far as it was. And positive events, telework. So people are still able to choose where they live, and telework. So that always promotes healthy prices. So you can see during the recession, slight recession we had during the beginning of the pandemic, recession increased to 14% and has thus come down to 3.6%. I remember that. And of course, we could talk about, are they underemployed and things of that nature? What is the true unemployment rate? I know a lot of corporations are laying off as lending increases. The smaller companies that leverage a lot, any high leveraged company like the tech companies, are not doing well, and they are laying off, such as Bitcoin. So I don't know where these numbers are going to start to show the actual, because I personally feel that 3.6 is way too low. I don't know about anybody else. Anecdotally, I have a lot of friends that have been laid off. So increased rates, increased mortgage. So this is U.S. average monthly rent, and this is in the Washington Post, 14%. And you could actually plug in your area or your area of your friends. So you could play around with that, where rent has increased the most. Urban Turf, a local forum, just published an article about increased rents in D.C. and how people are feeling it. They were giving away rent in the beginning. Even Manhattan was giving away rent. People were like, man, Manhattan never looked better to live in. It was so cheap. But now it's getting expensive. $5,000 in Manhattan is the average cost of somewhere to live. $5,000. So looking forward, and we rates will rise until recession hits. That was the rhythm, and maybe I'll change that. Rates will rise until inflation is fought and maybe won. So I think, and this is my point of view, Fed will continue to increase rates until inflation is tamed. There we go. Real estate does well during a recession. So we were talking about that. Values will not drop in this area. That is a fact. And I will show that to you if you'd like. Rates are here to stay now, 5.25%. Now, Jeremy, do you think they're going to dip lower than 5%? I have a feeling 5% is probably the baseline. I don't see them getting maybe in the 4s, but definitely not in the 3s. That's my opinion.
I mean, like I said, some jumbo loans we're doing right now are in the 4s. So
I'm talking about 30-year fixed.
30-year conventional. Yeah, and it's going to get back below 5%. Like I think in the 4 to 4.5% is probably going to be a good target. I don't know that we're going to be back in the 3s for a while. If and when that'll happen, but I think 4 to 4.5% is a realistic target.
Okay, that's good to know. 4%. So they're here to stay for now. So rates now, as Jeremy said, the best 30-year conventional is 5.25. I haven't been seeing that as much. And you could always talk to Jeremy. Is it worth buying down? At what point does jumbo loans like ARMs take into effect? So raising rates negatively affect demand, but does not affect supply. So supply is going to keep coming out. And I'll pull this up. In Washington, D.C., supply is going to continue to come out. So in June, the stats just came out, and you can see the thermometers from left to right, all the way to the right. Months of supply, boom, 5-year high. We're at 2.2 months something sits on the market. So houses are sitting on the market for a longer time to get it under contract. The second one to the left, active listings, there is more active listings, 200 more listings than the 5-year average. That's, you know, that's almost a 10% increase in homes on the market. And I'm sure if you open up Zillow, Redfin, you could see more houses on the market than you've ever seen in the past 5 to 10 years. Whoa, I didn't think this. New pending sales dropped by 160. So that's over 30%. So it's really slowed down in terms of production line. So not only they're more on the market, but less are pending and less are closed. So you're seeing some held up in new pendings. Another article came out that there's such a high rate of contracts falling through. So, you know, to these investors, you might keep an ear, you know, maybe follow up with that listing that went under contract and say, hey, you know, if anything happens with your contract, I'm interested. Because by the second time around, they don't want any BS. They don't want any of that first-time home buyer jitters. They don't want that buyer that's going to do an inspection and kill them. They just want clean, whole cash. They don't want any problems, and they just want to close. And they'll give a discount for that. And I have been seeing that a lot more often. We took a house off the market, all cash, and it was in a good zone. We're going to build over 20 condos, no competition, which was fascinating. Usually people chomping at the bit for a 12th Street Brookland development opportunity. We were the only ones in the game, and we were able to play just market rate. Fantastic. And it was on the market for only a day. So something that couldn't have happened months ago. So all consumers have housing costs. Either you pay rent or you pay a mortgage. So that's good news for us investors. I'm not concerned because my tenants are going to stay there. They're like, Nick, you've been a good landlord, man. Like, we were going to move, but can I stay here for 7 more months? I mean, these guys worried about everything. The heat was not the best. I had to, you know, get the attic insulated. I had to do all these things because they were pickier renters. But at the end of the day, they didn't want to move because they knew the alternative was higher. And I'm listing a property for rent. One's in 11th Street by where we'll be, and we're finding out we're getting a ton of showing inquiries, and people are really coming out and willing to pay the price. So it's either rent or mortgage rate. You know, pick your poison. Fannie Mae forecasts modest recession in 2023. So Fannie Mae came out with this report back in April, and Carlos was really hot on it, saying, hey, look, you know, people are going to be talking about recession, and we said it here on Grid. He probably said it before me, but I'm saying it here, not to scare you, but just to say that you're going to hear this back chatter of recession. And I just want to say on behalf of Carlos is recession is not synonymous with a real estate downturn. And because recessions are actually good for real estate. All we're saying is that housing prices are not going to increase as much. So 3.2% housing appreciation in Q4 of 2023. So we're not going to, we were spoiled, so to speak, for the past 2-3 years. Rates were low and prices skyrocketed 20% in some counties, including Arlington. Arlington had a big number. Arlington, Fairfax actually had really high numbers. Over 12% appreciation in 2020 and 2021. Happy to share those stats with you. But now we're coming back to reality. 3% is good. You know, that used to beat inflation. You know, inflation's usually at 1 or 2% if we remember. And I'm just going to share my screen right here. I might have to, and I want to share this article with you after this call. I'm going to share the window. I think this is it. No, can't share that. Share window. Oh, man. Let me try again. Bear with me just a second. Here, I'll share my entire screen. Hold on 1 second. I'll have to send it around, but I'll read the paragraph from it. It says, While growing affordability constraints point to strong pressure for home prices to converge towards more historical normal relationship to household income, we are not expecting that a next recession to result in a 2008-like housing or financial crisis. Mortgage credit quality is far superior in the current period. Both residential real estate in aggregate and the mortgage finance system are less leveraged now. And mortgage services and public policy are better equipped to deal with delinquencies, to provide loan modifications or other home preservation strategies as needed. There also continues to be a long-run undersupply of homes available relative to demographic demand, and we will therefore expect new home construction to play a leading role in eventual recovery. That was from the Fannie Mae article released. And when reading that, all I heard was that it's not going to be like the recession of 2008, and we have different things that are playing in effect now. Let me just go back to presenting. So yeah, I'm not expecting my DC row house to go from $1 million to 1.2 or whatever its value, maybe 1.2 to 1.4. But I do expect to hold its value. That's my main takeaway. And if you're on Jeremy's, if you do a loan with Jeremy, he has something called Robo Market Pro 2050 or something that sends you the value of your house. And I always am intrigued. You know, I have 2 houses that I did with him. Just goes to show how good Jeremy is. But it shows the value of my house, and you know, it shot up by over 200,000, but I don't think it's going to shoot up anymore. But a cool little tool that Kingsbury has. I don't know if you could see this, but something what I said, decreased in closed sales, median prices going up, so still 6% in June compared to versus June of 2021, up 6%. Decrease in pending sales, like I mentioned. And I guess compared to last June, decrease in listings, but active listings has stayed afloat. And this is the this should say June. Oh, the weekly report. Okay, so we do monitor the market weekly. Inventory continues to rise. It is as low as not seen since April of 2020. So again, going back to normal, April 2020, with new contracts slowing, closings, so everything's slowing. It's fallen 11% over the last 2 weeks, with closings down, and showings have gone down. So a little bit slower. That's it for our presentation. I want to stress the next one's in person. It's going to be on 11th Street in the Columbia Heights Row House. This is, and I don't think we're going to do virtual, so I'm really going to push you all to come in person. Maybe we'll do virtual for the first few. But the whole point of Grid is being in person and to meet each other. So thank you again for everybody for joining. I'll be on for any questions. But thank you, Jeremy, for our guest. It was amazing. Amazing conversation about the market. Curious to see what's ahead in terms of where rates are going to go after December.
Thank you, Nicolas.
You're welcome, Sonia. Good seeing you.
Thank you, Mr. Jeremy.
Absolutely.